Welcome, everyone, to our post-election year-end tax planning webinar. I hope everyone and your families are doing well and navigating these challenging times. My name is Joe Bublé. I'm the tax practice leader for Citron Cooperman, as well as the tax partner in the New York City office. And today's webinar will take you through some of President-elect Biden's tax proposals, some year-end planning thoughts, and things that you should be thinking about. Here we are on November 11th, and we thought when we planned this about 2 months ago, we'd have some more clarity as to the composition of the Senate and the House, in addition to the presidency, but we don't have that, and we'll go into some detail about that a little later. So a lot of these are going to be thoughts and things that you should be thinking about given the uncertainty that we have. So before we get into the program, I'd just like to do some housekeeping. If you go to the next slide, some reminders. The webinar will be about an hour. And everyone on the webinar has been joined in the listening mode only. However, you can submit questions to the speakers and myself by typing your questions into the Q&A icon on the Zoom panel, which you see on the bottom. In addition, the session is being recorded, and we're going to send around a playback link when it's over so you can listen to it at your leisure and share it with other people. Okay, so now let's just start off with the polling question number 1. For those of you that are joining us today, do you require CPE? So we put the question up. We'll give about 30 seconds to answer this difficult question. Then we'll see what we have. Okay, just a couple other seconds. And we'll shut down the question. And we'll see the results. Okay, and the answer is 80% yes and 20% no. That's great. Great to hear that. Okay, so if we go to the next slide, we'll go through the agenda. So we're going to talk about income tax proposals by President-elect Biden. And to do that, we have Ron Hecht, who's a tax partner in our White Plains office, as well as Pat Daly, who's a tax partner in our New York City office. And both Ron and Pat work with high net worth individuals and businesses. So they'll cover the income tax aspects. And then we'll go to estate and gift tax proposals, and there are a number of those, but very important ones. And for that, we have Howard Klein, tax partner in our White Plains office, and Howard also is the tax practice leader of our estate and gift tax section. Then we're going to have David Seiden come in and talk about some state and local tax issues, things he's been seeing with people working at home given the pandemic, as well as the recent ruling that just came out this week from the IRS on some state and local tax matters. And last, but certainly not least, we have Leon Dukowitz, who's a tax partner in our Philadelphia office. And Leon is also the tax practice leader of our international tax section. And Leon will talk about some of the international tax proposals. But before I turn it over to Ron and Pat, we just wanted to set the stage to see where we are so we're all on the same page, and things are changing with regard to the election as we speak. So obviously we have the President-elect Biden in place, a Democratic challenger to President Trump, and he has a variety of proposals. Some have more details than others, and that's what our speakers are going to go through. But of course, we don't know which proposals will get passed, if at all, and that will be determined largely by the composition of the House and the Senate. Now, the House right now is 218 Democrats. Just within the last few days, it was some final races were counted, so we do have 218 Democrats in the House, so they will maintain their majority. As we are on this webinar right now, the Republicans, however, have picked up a net 6 seats in the House. So the Democrats still have the majority, but it is narrowing, depending upon the news service you follow. Right now, there are about 14 races that haven't been called yet. 14 races haven't been called. So the important of all that is that there are many, many House members on both sides of the aisle that are in very, very competitive election districts. And that may temper someone's enthusiasm for passing some of the tax proposals and other things that President-elect Biden has proposed. So again, remains to be seen, but that will be a Democratic majority, though narrower than it was before. And then we come to the Senate. So right now, within the past hour and a half, the last 2 races that are in the process of being counted have been called. So the Republicans have 50 seats in the Senate. Democrats and parties that caucus with the Democrats have 48. So we're down to the last 2 races in Georgia, which will both be the subject of a runoff election, we believe, on January 5th, 2021. However, within the past hour, I just saw that the Georgia Secretary of State had just ordered that every single precinct hand count and audit all the ballots that were cast in the presidential election. So it remains to be seen if that recount will change the results in actually one election. That was David Perdue. He had 49.7% of the vote. He needs to have a majority. That's why there's a runoff. So it remains to be seen if that will change. Again, another unknown question, which is probably typical for this year. So the point is, we don't know what the Senate will be. If there is a runoff and the Democrats win both runoff elections, it'll be a 50-50 tie, assuming people vote along party lines. And of course, in that case, Vice President Kamala Harris then would cast the deciding vote, effectively giving the Democratic Party control of the Senate. Again, that'll impact some of these tax proposals that we're going to talk about as whether they get passed or not. The other thing worth noting is that back in 2017, when the Republicans had the presidency and controlled both houses, it took them until December 22nd to enact a legislation, Tax Cuts and Jobs Act. So it took them a year to get their act together to figure out what they wanted to do. And it's likely to be the same thing amongst the Democratic Party. It's a big party, a lot of people in tent, a lot of varying opinions on things. So it may not go as smoothly as some people think and take a while to get legislation. And the longer it goes, it's the more likely that the legislation that is passed won't be effective to 2022. Again, an unknown question. So that's where we stand right now. Typical for this year, a lot of unknowns, a lot of questions. And with that, I'll turn it over to Ron Heck to talk about some individual tax matters. Ron?
Okay, thank you, Joe. There we go. Thank you. Yes, 2020 has been a year like nothing that any of us have ever faced. We're facing the same issue with year-end income tax planning. I'm going to spend a few minutes talking about the individual income tax proposals from President-elect Biden, compare them to where we are under current law, and then when I finish talking about these proposals that we're looking at, we'll talk quickly about what do we do about tax planning. And where we are in tax planning this year is really uncharted and unknown territory. We don't know come 7 weeks from now where we might be with income taxes. But some of the things we'll talk about really are insurance type tax planning. And what I mean by that is if you plan for a higher tax rate in 2021 this year, and it turns out that there is a higher tax rate, then we've done the right thing. If we plan for higher tax rates next year and they turn out not to be there, at this point, it's sort of an insurance policy type planning that what's our worst case scenario? I've accelerated a little bit of income from 2021 back into 2020. And my cost is the time value of having to prepay the tax that I would have paid in 2021. So let's look at some of the provisions that are on the slide in front of us. President-elect Biden's proposal on capital gains, which are currently at a top rate of 23.8%, which is a 20% top capital gains rate and a 3.8% Obamacare surcharge, would rise to individuals with $1 million income or more to ordinary income tax rates. So high net worth, high earning individuals would see capital gain, long-term capital gains rates jump from 23.8 to 43.4%. It becomes kind of obvious that the plan there is if you're willing to, as I mentioned, pay the insurance policy by accelerating long-term capital gains by taking gains in 2020, You may prepay some taxes, but you may also conceivably save close to 20% tax on long-term capital gains. Just a quick side note, as long as we're talking about capital transactions, on the flip side, if you've got any losses that you are sitting on, and the details are beyond the time that we have to discuss them, but the wash sale rules would conceivably allow you to take your capital loss this year in the 30 days running up to the end, as long as you do that by the end of November, in the 30 days running up to the end of the year, if you buy back the security, you've triggered the wash sale rules, and there are some techniques that can be discussed at a future date with your Citrin Cooperman advisor that would allow you to, after the fact, in early 2021, when we hopefully know the outcome of where we are in control of the Senate, be able to determine which year you're going to push your capital loss into. In the ordinary income area, not as dramatic a change. President-elect Biden is looking to increase ordinary income rates back up, the top rate, back up to the 39.6% rate that was in effect pre the Tax Cut and Jobs Act. We will talk when I'm through going through the next three items, what a potential planning opportunity is worth in terms of accelerating if you are an employee, do a big year-end bonus, and your employer happens to be an accrual basis employer and is willing to prepay your bonus this year. In a few minutes, I'll show you the magnitude of the savings, of potential savings of doing that. The FICA and self-employment tax change is a dramatic change. Current law has us paying in either FICA at 12.4% by both the employer and employee combined, or the self-employed individual paying 12.4% on up to $137,700 of wages or self-employment income. The president-elect's proposal, the 137.7 would rise under current law with inflation to 142.8, but what's in his proposal is in effect a donut type tax, where in the middle of that donut hole between 142.8 and $400,000, there would be no additional Social Security or self-employment tax. But for individuals earning wages or self-employment income in excess of $400,000 with no cap, the self-employment tax and FICA tax would be reinstated. Itemized deduction benefits. There are numerous small changes that are being talked about. The single largest detriment is that the president-elect's proposal is going to cap the benefit of itemized deductions at 28%. And lastly, the P's limit. And that's a provision that was introduced by the late Robert Pease, who was a member of the House from Ohio. And I guess his name now lives in infamy because the Pease limit is a deduction limitation for high earning individuals in the $260,000 range if you're single, or the $320,000 range if you're married filing a joint return. And if your income is in excess of that amount, your itemized deductions are reduced by 3% over that base amount. So effectively, that's a 1.18% hidden tax increase. If we can go to the next slide, I'll show you the magnitude, and this, of an individual either trying to accelerate self-employment income or asking their employer to accelerate the year-end bonus. And if we're talking about a $100,000 acceleration, you'll see the ordinary income potential increase next year is 2.6%. If we're in that highest bracket, then we are certainly over the $400,000 of earned income. So you'll be adding an additional either 6.2% or 12.4% of payroll taxes. The P's limit is that hidden 1.18% tax. So you can see that an individual getting a bonus or accelerating self-employment income into 2020 would pay a 37% tax rate as opposed to a 46.98% rate if you're an employee, or a 53.18% rate on the additional income for a self-employed individual in 2021. So in $100,000 accelerated income, your wages, that wage acceleration could save you $9,980. Your self-employed individual could save in excess of $16,000. Now, the other things to look at are, do we potentially want to accelerate some itemized deductions into the current year as a possibility of a way of saving some tax by getting a 37% itemized deduction benefit versus the potential limitation at 28%. Again, we're talking about uncertainty, but it becomes a question of working with your advisors and determining, am I willing to accelerate what might be the same tax next year in exchange for some of these potential savings? At this point, if we can have the next slide, and my partner Pat Daly will take over.
Thanks, Ron. Thanks for all those informative points. You did a nice job. So we're going to change it up a little bit here, and we're going to focus on some of President-elect Biden's business proposals. So from a business point of view, there are basically two methods of accounting, as we all know. It's the accrual method and the cash basis method. And depending on which method you use, I just want to point out a few items to consider with President-elect Biden's proposals. First of all, let's just take a quick step back to understand the main difference between accrual and cash. It basically stems on the fact that the difference lies in the timing of when revenue and expenses are recognized and reported. Accrual means revenue and expenses are recognized and reported when they occur, and cash basis accounting means that revenue and expenses is recognized and reported when cash exchanges hands. So with accrual-based accounting, we determined there's not too many planning opportunities with President-elect Biden's proposals in 2020, since the revenue and expenses are recognized and recorded when they occur. However, we just heard Ron speak about some potential changes to tax rates. And one important point that we think that accrual-based taxpayers can focus on is the depreciation. Now, the question is, if we purchase assets today or up to 12/31, and you place them in service, that's the key, and you place them in service, you can measure when your depreciation expense will occur. If the assets are placed in service in 2020, the depreciation will be recorded in 2020. If the assets are placed in service in 21, the depreciation expense will be recorded in 21. So there's no cookie cutter approach here. So each taxpayer is different. Could incurring additional depreciation deductions be more valuable in 21, as Ron alluded to with the increase in tax rates? Or do I want that additional deduction in 2020 by placing those assets in service in 2020 to create an NOL? So what would an NOL do for you? If you're in a business that has a cash need, you can carry back your NOL up to 5 years. So if you've paid tax in one of the previous 5 years, you can carry back your net operating loss and recoup some of those taxes that you paid. So there's a planning mechanism. You know, where do you stand? Do you need that cash to go back, or do you want to use that future depreciation deduction to offset higher tax rates? Now, one important point that I want to talk about is bonus depreciation. Now, you'll get more bang for your buck with bonus depreciation. President-elect Biden has not completely stated what will happen with bonus depreciation. However, I've read a number of reports and proposals, and most people believe that bonus depreciation could be eliminated or somewhat curtailed. So that could affect your thinking. Do I want to place that asset in service in 20 versus 21? Hopefully, we're going to get some more guidance on that shortly. The other method that I just wanted to touch upon was the cash basis of accounting. To me, you have a lot more flexibility as to when income is earned and when expenses are measured. For example, if you know most clients pay you within 30 days, you can delay your billing process until 12/15. So effectively, the income will not be reported until 21. But remember what Ron stated, rates will probably be higher in 21. So do I want a bigger loss in 20 to carry back, or do I want that expense to offset those higher rates in 21? A lot to think about with bonus depreciation. You know, we were pondering also from the accrual, the depreciation expense was a viable alternative that we thought about. Cash basis accounting, you can control what you want to do. If you want that expense, you can prepay some expenses and get the deduction in 20. So there's a lot to consider and a lot to map out to determine, you know, how you want to, what you want to do over the next 7 weeks. One of the other, one of the main provisions of the Tax Cuts and Jobs Act was the reduction of the corporate tax rate to 21%. This previously was as high as 35%. Now there's a competitive, there's an international competitive tax index that measures tax rates in various countries throughout the world. With the reduction to 21%, the US was ranked 19th out of 36. However, President-elect Biden proposes to increase that corporate tax rate to 28% now. And that's not going to be a graduated rate. That's going to be a flat 28% rate on income. So with that increase in rates, that could have a trickle-down effect to many other tax provisions that are out there. Section 199A could be phased out. From the international side, the GILTI provisions and the FDII provisions that Leon's going to be discussing in a few minutes could be adversely affected by the increase of corporate tax rates, because those were all commingled when the tax cuts were passed in 2017. So what else could happen with that, the tax rates being increased? The US competitive balance could be changed. Taxes play a vital role in business decisions. Where is a business going to expand to? Where does someone want to live? Where do I want to invest? And with the proposed increase to 28% on that competitive index I talked about before, the US index will rise to number 33 on the chart of 36 countries that the index tracks. A few other points that we want to talk about that affect the business side. Like I said, Ron did a great job on the individual side. We just want to outline some of the business proposals. Many people on this webinar deal with clients in the real estate industry. President Biden has stated that he wants to eliminate, and I quote, unproductive tax cuts for high-income real estate investors. High-income real estate investors are basically people with income of more than $400,000. No one is sure what that means. But the speculation is that this could mean to eliminate or reduce the like-kind exchange rules, which has been a staple tax planning move for people in the real estate industry for decades. So that's very important for people in the real estate industry. I know us at Citron Koopman, we spend a lot of time with clients in the real estate industry. So this is something that we want to learn more about as we get more guidance with President-elect Biden's proposals. A few other things that I want to talk about that I thought were interesting that probably does not affect many of the Citron Koopman clients. One was, President-elect Biden thinks a lot of the companies such as Amazon don't pay any income tax. They have book income, but with all the tax benefits out there, they have no taxable income. I thought this was interesting, and like I said, it probably doesn't affect many of our clients. President-elect Biden is proposing to impose a tax of 15% on book income with taxpayers in excess of $100 million of income. So, interesting concept: a tax on book income for income over $100 million. President-elect Biden also has a number of proposals that deal with work opportunity credits, disabled people. He wants to give small businesses additional credits. More to come on that. He really hasn't outlined how that's going to all work, but he's looking to give those types of credits to businesses that are hiring these types of individuals. One other point, and I'm going to pass it on to the next speaker in 1 second, that I want to point out that could affect all of us as individuals. Ron did a great job outlining the individual rate increases, the deduction limitations, etc. But one proposal that's out there is President-elect Biden proposes a financial transaction tax. And what does that mean? This would entail placing a tax on all stock, equity, and derivative transactions that one makes. So if you sell a stock, there could be a small tax. A lot of people are adhering this to like an additional Wall Street tax. Now, no one knows what that tax rate would be, but people are speculating that rate could be between 0.05% to 0.2% per trade. So more to come on that with the transaction tax. And there are a number of other business provisions that we're not going to go into. There's some manufacturing credits that are out there. Biden is going to go after certain industries that he believes should be getting credits, but more to come on that. And but the biggest components that I wanted to stress was the increase in the corporate tax rates and the planning mechanism for depreciation, depending on your method of accounting with accrual or cash basis. I'm going to pass it on to the next speaker. Thank you.
Thanks, Pat. This is Joe. I have a couple questions that came in from the audience that I'll run through Ron and Pat before we get to Howard. So Ron, I guess these are really for you. Just on the proposed increase in the FICA tax on $400,000, can you just comment? That's on both sides. That's the employer and the employee share, correct?
Everything I've read, and the proof is in the pudding, as they say, but everything I've read is that the wage base for high earners is being increased, and everything I've read reads that as 6.2% on employee and employer. Yes.
Okay, great, thanks. And then another proposal, Ron, in the area of itemized deductions is a elimination of the state and local tax deduction cap. So we will go back to the way it was before, that all state and local taxes are deductible, subject to, as you said, the Pease Amendment, and as well as the AMT now comes back into play, correct?
Right. Alternative minimum tax that seemed to have been pushed into a corner may be crawling its way back out.
Okay. So the state and local deduction proposal is to bring it back to the way it was. And the last thing is on, someone has a very good question on accelerating required minimum distributions into 2020. Now, I believe you don't need to take them in 2020, but let's just get your thoughts on that. That do for somebody, if anything.
That becomes an individual case-by-case kind of scenario, but if you're anticipating higher rates, there's not a huge downside to doing it. But by taking a distribution in 2020, there's still going to be the requirement to take one in 2021. It's not like a year is going to be skipped. It's just that you may be able to pull 1 year, potentially pull 1 year's distribution into a year that in hindsight might be a lower tax rate.
Right. And
Joe, Joe, remember also with the RMDs, if people are charitable inclined, they can allocate some of their charitable benefit to reduce their taxability on the RMD.
right, good.
Right.
Okay, good. Thanks, guys. This was great. And now we'll send it over to Howard Klein. We'll talk about some of the estate and gift tax proposals. Howard?
Thank you, Joe, and good afternoon, everyone. I want to talk to you today for a few minutes about overall estate and gift tax planning. I also want to jump on something that Ron just said. Like with income taxes, there is no one-size-fits-all with estate planning. I like to use the phrase, everybody's a snowflake. Everybody's plan is different. Everybody's families are different. Even within a family, there may be differences of opinion. So always keep that in mind as you go forward. Due to time limitations, I'm not going to go too deep into this topic, but rather give you a broad overview. So there'll be no Internal Revenue Code section cited, and with a few small exceptions, no math. A little unusual for a tax presentation. There's been much discussion throughout the year on how the election might impact this topic, and so our goal today is to give you an update on where things currently stand, what may or may not change, and most importantly, what steps we are suggesting people take before the end of the year. So for purposes of this presentation, and you can see that throughout, I'm going to assume former VP Joe Biden will be president in early 2021, and Senate control is still uncertain. So for disclaimer purposes, anything that might happen in the near future to deviate from those assumptions should be considered. They certainly don't make things easy. So what are some of the major topics that are going on and being discussed right now? The post-election estate planning discussion centers around three major proposals that the Biden campaign laid out. The first of these proposals is a reduction of the current lifetime estate and gift tax exemption of its current $11.58 million per person, or approximately $23.5 million per couple. This exemption was doubled with the Tax Act of 2017 that Joe previously mentioned. Currently, it's scheduled to sunset or revert back to pre-2017 levels starting in 2026. So the election results could accelerate this and other changes. We're not sure to what extent the exemption will be reduced. However, planners believe it could be as low as $3.5 million or more likely $5 million, both indexed for inflation. The second is a proposal to increase the top estate tax rate from its current 40% to, we've seen numbers as about 45%. But it wasn't so long ago that this rate was actually 55%. Another thing that we can see how that plays out during next year. The final proposal is the repeal of the step-up in basis on assets inherited at death. This proposal, if enacted, would have the most dramatic impact on estate and even income tax plan. So I want to just very briefly and discuss what is the step-up in basis rule. So for those of you that already know about this and are familiar with it, forgive me. So currently when a taxpayer dies, the assets in his or her estate receive a basis adjustment up to the fair market value of the asset as of the day of death, meaning that their heirs could sell the asset without realizing any additional income tax, except for any increases in value post-death. So by way of an example, if I purchase, say, a stock for $100 and sell it for $1,000, I pay tax on the $900 gain. It's pretty simple. If, however, I hold the stock until I die and my heirs receive the stock when it is still worth $1,000, they can sell it the next day and pay no tax, since their basis is not my original basis, but the value at my death. Hence the term step up in basis. Repeal of this rule could impact all inherited assets unless there are thresholds or other exceptions. We've been talking about a situation where you have children who just are inheriting the family house, which their parents might have paid $100,000 for. It might be worth $400,000 or $500,000 now. Currently, under current law, if the children sell that house with the next day after the parents pass away, then they would pay no income tax. So here, although people think that these estate tax exemptions are geared towards the higher people with the higher net worth, it could affect everybody. We just don't know. And not surprisingly, there are no specific details about this proposal. We've actually seen some discussion about implementing the tax at death, making it due within 9 months of death. So what we would call a deemed sale. But since not every decedent is required to file an estate return, the question as to what form would report this tax is also still uncertain. And if you consider some of the income tax proposals that Ron mentioned, with capital gains being taxed at ordinary income tax rates, you begin to see how much of an impact this could actually be. Ron and I went through an example with, let's say, a $10 million estate where I believe we discussed that the effective rate, both income and estate taxes, if all of these proposals are fully enacted, could be as high as 67%. So although this is, let's change the slide. Although this is not a political webinar, and Joe mentioned a lot of this at the very, very beginning, it's difficult, if not impossible, to talk about taxes without talking about the political landscape. So with control of the Senate unknown until the 2 races in Georgia are decided in early January, could be now earlier, which we found out, an hour before this, current planning is made even more difficult. And always bear in mind that any changes made during calendar 2021 could be retroactive back to January 1st. We just don't know. There's been historic situations where changes have been made and they have been retroactive. So this risk and uncertainty has caused some clients to think about locking in their exclusion amount now, meaning 2020, by making gifts prior to the end of the year. So advance the slide. The slide is fine. So I wanted to mention the current environment. So the current environment right now, and we've been discussing this all year, even before the election, remains the most favorable for potential gifting of assets. We may never see these types of laws and rates and exemption amounts for the foreseeable future. We already mentioned the potential decrease in the exemption, the increase in the top estate tax rate, and the appeal of basis step up. In addition to that, if interest rates are at historic lows and asset values may have been reduced, some very significantly, as a result of the pandemic. So therefore, how should one proceed? Please advance the slide. So what is our process? And we've been doing this throughout the year with many, many, many clients. First, identify those clients that have not used up their lifetime exclusion. Think of it like a coupon or maybe even a double coupon that's available to you. Second, have or assist clients, and I don't know who's listening out there, in gathering their financial information, their legal documents, and have the current plan reviewed. I've said this many times, everybody has a plan. Even no plan is a plan. It might not be a good plan. It might not be the plan you want. It might not work under the current situation with the current tax laws, but everybody has a plan. So have it reviewed and simply look at what happens if I do nothing. It is the basis for all of our planning engagements. Ask clients, or if you are listening and you're a client, think about what you are trying to accomplish. What are the client's goals? What are their concerns? What are their fears? After all, this is about them, not about us. We are here to guide them through the process from beginning to end. Most importantly, before deciding to make any large gifts, work with your advisors collaboratively, and if you were one of those advisors listening, work collaboratively with the client's other advisors to ensure that their cash flow needs and independence are not compromised, their assets are protected both from potential beneficiaries and outside creditors, and that your plan can mitigate IRS risks of audit. In other words, look before you leap. Before I close, I want to remind everybody that the estate tax is somewhat voluntary as one can arrange their affairs to avoid this potential tax. However, one thing is certain, whether or not your assets are or might someday be subject to the estate tax, you should be aware and assess how your assets are going to pass to your heirs upon your death. I believe now we have our second polling question. So our question is, are your clients doing any of the following between now and the end of the year? Making gifts of cash, gifting an interest in a closely held business, revising their estate plan, all of the above, none of the above? Please answer. Thank you. Back to you, Joe, or whoever's doing the polling question.
All right, I'll take it over. Howard, we'll see how the polling comes in. I think Stephen will close it in a few seconds. Some interesting questions here. Okay. Very good. So we got 43%, all of the above. Nice to see that. I see their estate plan, 10%, interest in a closely held business, 4%, and gifts of cash, 21%. So good, very, very good. Could be better in terms of making sure people take advantage of those exemptions that you say, Howard, that may be going away at no cost. So with that, I'd like to turn it over now to, I believe, David Seid in State and Local. Dave?
Got it. Thanks, Joe. And good afternoon. I'm David Seidel. I am a partner at Citron Cooperman and the practice leader of our state and local tax practice. First, I need to apologize, and I'm sure you can all appreciate this, since we've been working at home doing these video conferences. Right now, I've got the neighbor's gardener blowing leaves, and it's giving me an incredible headache. So if the volume is not great, I apologize, but I can't tell my gardener, someone else's gardener, to stop blowing leaves. I'm going to spend the next few minutes touching on two things. Number one is, what, if any, impact will Biden's tax proposals have on taxpayers from a state and local tax perspective? And second, how COVID-19 has already had a pretty significant effect on a lot of different areas within state and local. What we did is we grouped the Biden proposal into three buckets to see what, if any, tax, state and local tax effect there may be. So when you look at Biden's proposal, you have increase in federal tax rates. There's various increases that are going to go up and certain credits that are coming and going. What we do know is that any change in federal tax rates or credits typically have little or no effect on state taxes. I think there's maybe one or two states that say a percentage of federal taxes is what you owe, but in the vast majority of states, a change in rates is not going to have any effect from a state and local perspective. The second area is the rollback of depreciation to potentially pre-TCJA levels, which means no more bonus depreciation. And the reality is that most states specifically had carved that out and don't allow bonus depreciation today. Again, please keep in mind, whenever you're talking state and local taxes, we always say it depends, because we're talking about 50 states, 6,000 local jurisdictions. It depends, but as a general rule, most states don't allow for bonus depreciation. And then the last area was the reduction in the QBI deduction potentially, which is again on Biden's proposal. And again, much like the other two areas, most states never adopted QBI, and therefore there should be no state and local tax impact. Next slide, please. So what does this all mean? I think the first bullet is just a recap of what I just said, that there's very little in the Biden proposals that will have an impact today on a taxpayer's state and local tax burden. But I do think what's going to come out of this is that as a result of COVID-19 and the unbelievable dire financial conditions most states and localities are in right now, all of them are looking at increasing tax rates. And in fact, New Jersey just increased tax rates on taxpayers that make over $1 million. Currently, there's legislation in a number of states and localities to increase tax rates to try to cover many of the budget shortfalls that a lot of them are now facing because lost sales tax revenue, lost payroll tax revenue. A lot of these, the economy-driven taxes, the transaction taxes, have been significantly curtailed, which means a lot of these cities and states that are continuing to spend money to help curb the spread of COVID are just finding a bigger and bigger hole in their deficit. What has this caused? The increase in the tax rates has caused a lot of individuals to reevaluate where they want to live and where they want to work, especially given, just look at us today, we can do an entire webinar, seminar, and be anywhere in the world right now. So a lot of taxpayers are reevaluating where they want to live, given the incredibly high cost of taxes it is to live in certain jurisdictions, and are thinking about moving to low or no taxing jurisdictions. Next slide. So when I go to the airport, and there's two ways. There's always the line. The Florida line is always the longest, and there's two ways people get to Florida these days. For those that can, they get on their private jet, and for those, much like myself, we sit in these type of planes and deal with masks and everything else. Next slide, please. So before I get into what this all means to you as taxpayers, I do want to make mention of one thing that just happened on Monday. And I generally don't get to talk about Treasury regulations and the IRS, but on Monday, the Treasury announced that the IRS is going to be issuing proposed regulations on the deductibility of state taxes paid by pass-through entities for state taxes. As you may or may not know, there's about a half a dozen states, including New Jersey, Connecticut, Rhode Island here in the Northeast, that have imposed pass-through entity taxes, partnerships, S-corps. And what that was specifically done was done to circumvent the federal $10,000 limitation on state taxes that came into play in 2017. So a handful of states had decided that they were going to allow the pass-through entities to pay the tax, get the deduction for federal taxes, and then have the partnership or S-corp flow through on a pro rata basis the amount of tax that was paid to the individual partners or shareholders, and allow them to take that as a credit on their individual return. In essence, it put people in the same position as if they were allowed an itemized deduction, in certain cases a better position if it was limited, but put you in the same position as if you were allowed to do the itemized deduction of state taxes without it going through the cap of $10,000. Now, the first state that did this was Connecticut, and theirs was a requirement. So any pass-through entity had to do this. Since then, states like New Jersey and Rhode Island have enacted, and New Jersey is just for this coming year, is effective for 2020, and it is elective, and it doesn't have to be elected until you file your return, the due date of the return in 2021 without extensions. But there was always concern from people in our business that maybe the IRS was going to come in, realize that this was just a workaround, and disallow the deduction at the partnership level, which could have caused there to be an increase in the taxpayer's federal taxable income, and they would have been a shortfall on taxes and penalties and things like that. So we've been kind of on the fence as to whether or not to recommend that flow-through entities avail themselves of these elective pass-through entity taxes. Again, on Monday, the Treasury came out and said, IRS is going to issue proposed rules saying that these are good deductions. So I think the uncertainty has now become certain that it's a good deduction. And I strongly recommend that taxpayers that operate in a flow-through entity in states like New Jersey and Connecticut, again, is not your choice, Rhode Island, I think Wisconsin, Oklahoma, and Louisiana, if I remember correctly, all have these types of taxes. Should take a hard look at whether or not it's something that you want to elect and discuss it with your tax advisor. Finally, what does all this mean as far as, especially the states at this point are very much taking a hard look at how they're going to generate revenue, but not only are they going to increase tax rates, but there's no question they're going to be increasing the audit activity. And we're already seeing it. And people that think that They could change their domicile and go to Florida, get a Florida driver's license, and as long as you're down there for more than 183 days, you're good to go, and you're no longer going to be considered, as an example, a New York City resident. I strongly recommend that you speak with your tax advisor, because we help many clients in this area, and it takes way more than that to, in fact, be successful if challenged by the states that you change your domicile to another state. The last two items are as a result of all the telecommuting employees. Employers have to take a good look at whether or not they have to now start withholding taxes in the state where the person is telecommuting, where they had never been before, what the SUI rules are. You now have potential nexus in these states for both income tax and a requirement to collect sales tax. And because you have people all over the country potentially, you now have a different way of looking at how your income can be potentially sourced. And then finally, for employees that are telecommuting, depending upon the mix of states of which office you report to and the state in which you're telecommuting from, there is a risk that your income from wages could be subject to tax in two jurisdictions. The concept is called the convenience of the employer rule, which we just don't have time right now, but just for purposes of today, if you're in a state different than you were, and you're reporting to another state that you report to, you should be asking questions like, could this result in a double taxation? A lot of other things going on in SALT, which we hope to be able to present in the very near future. But at this point, I think that's the end for me. Yeah. Joe, I'll turn it back to you.
Okay, great. Thanks, Dave. That was good. A lot of things going on in the world of SALT and getting more complicated as everything else. So, but now we're running a little short on time, but we want to turn it over right now to Leon. And Leon is going to talk about some international tax matters. Leon?
Thank you, Joe. Good afternoon, everyone. So I get to wrap up today. A lot of things going on here. Clearly, with President-elect Biden coming in, tax was one of the main platforms that he looked to come in with. And I want to kind of set the backdrop for a moment, if I can, that, it did, as Joe said earlier, take, President Trump almost 2 full years to get TCJA passed. And some of the things in the provisions that were in there that affect the international business space really were complicated. And, we went from a transition tax to the global intangible low taxed income, or GILTI. And the GILTI tax, is one of the main focuses of what I wanted to present to you today, because it's likely that President-elect Biden will get either the Senate or possibly the ability to go cross aisle, as he has in the past, and his track record shows that he can. And it's possible, very likely, that if corporate tax rates move, GILTI is pegged to the corporate tax rate, so it will move automatically, number one. And if it doesn't move in the corporate tax rate, it could statutorily be changed as well. So in his proposal, the current rules are it's an effective 10.5% tax rate today, and it's scheduled to go to 12.5% in 2025. And right now, when you're doing the calculation in GILTI, for those that are dealing with it, it basically is a one bucket of income, which basically allows income in one jurisdiction to be offset by losses in another. Next slide, please. President-elect Biden's proposal basically would push the tax rate, the effective rate, to 21%. And more importantly, is it would eliminate the netting between countries. Each country would be basketed separately. So the losses of one country cannot offset the income of another. This likely will produce an immediate tax effect. And again, this is proposed in his budget but it's, you know, not likely, it will not be in effect for the current year, clearly, but there's no reason to jump early on in 2021, because again, it depends how long it takes something to be enacted, and the question, you know, when will this, if at all, be in taking effect? So the other piece of this that's very important on the GILTI side is the 10% return on average adjusted basis for tangible property would likely be eliminated as well. So again, watch this space, but it's something that we will present further in the future, but this is one of the bigger proposals in the international space. Next slide, please. Again, with the whole idea of, you know, when we're looking at offshoring and redomestication for U.S. job growth, that was part of his proposal, looking at a 10% penalty on the highest corporate rate. So if the corporate rate goes to 28%, looking at imposing basically a penalty of 2.8% for offshoring, you know, basically an offshoring tax penalty for a highest effective rate of 30.8%. Also denied deductions associated with moving jobs offshore. Basically, you know, when looking at the, you know, strong anti-inversion regulations and provisions that could be enacted as part of his proposal, because again, trying to really focus on this whole Made in America concept, but really offering and pushing for clawbacks, penalties, and increased tax rates to do such. Next slide, please. So a couple things to think about. You know, if the corporate tax rates move, GILTI and the FDII deduction will automatically move as well, because they are directly tied to the tax rates. Again, it's very likely that he will get support on the GILTI reform, because again, he has the ability to go across, you know, parties on this. It's also a revenue raise, and it's likely also one of the easier revenue raises. And with the political climate the way it is with offshoring of jobs, it's one of those areas that, you know, the profession feels that is likely to be focused on by President-elect Biden, and actually has good success, or a good chance of success in passing it. A couple of other things to keep in mind is repatriation. You know, really the whole goal of GILTI and the transition tax back in 2017 was to try to onshore, offshore money and tax it currently, and to get us on really a global basis of taxation versus you know, being able to still shelter offshore. Inversions, as I said earlier, is something that, you know, President-elect Biden intends to shore up the regulations and pieces that are out there. Transfer pricing is an area that has not really been spoken much about by President-elect Biden in his proposal, but it is an area that likely could pose more fertile grounds going forward. It's been considered by some of his top advisors. And expatriation is something that, you know, that when U.S. citizens leave the U.S. and give up their passport because they no longer want to be in the tax system, because again, U.S. tax system taxes citizens, not residency. So no matter where you live in the world, generally, if you're a U.S. citizen, you are taxed or subject to tax in the U.S. And a lot of folks that live overseas 100% of their time, they really have no need other than having the passport, but are subject to our tax system. And it's very commonplace that the amount of expatriations of our citizens is increasing. It's not a negative comment. It's more of a reality of where's your domicile, where is your living, and where are you center vital interest. That if you're not living in the U.S., the theory for the expatriation is, why stay in our system other than the ability to carry the passport? And a lot of folks have given up their passport. It's still an increasing number annually. Next slide, please. So with that, final polling question of the day, would you like additional information or to discuss any of these topics further? Yes or no? Very, very interesting. 74% would like additional information. That is great to hear. I'm glad to hear that it was very successful, that the information we're putting out, and as it unfolds, we will put out more information on each topic. Back to you, Joe.
Thanks, Leon. Great job, as always, and everyone did a great job. We're just about out of time, but had a lot of questions, and you know, how does this work? How does that work? I just want to caution everyone, as was been said, these are just broad-based proposals that President-elect has been made, very little details. So to get into, there are no details to get beyond what we discussed. So you just got to keep abreast, as Leon said, as more details become available. When you actually get written proposals, we'll of course share them with everyone. But I did have one question, Howard. I want to bring you back in on exemptions, and it actually is a twofold question. So the question was a very good question. If somebody used up, say, $2 million of their exemption now, and it goes back to 5, how much is left? So we would think the answer would be 3, correct, Howard?
I would agree.
Okay, but now let's change it a bit, and we'll talk about the clawback rule. If why the exemptions now are 11 million or so, and somebody makes a $10 million gift now, not subject to gift tax, and then it goes back to 5, what's the current position of the IRS on this?
From what we understand, that additional gift over and above what is the new exemption level would not be clawed back and be an issue with future estate tax, no matter what the exemption would be. So therefore, as we were actually discussing this yesterday with the client, making a gift above the potential $5 million exemption and the current exemption of 11 plus is kind of the play. If you can afford to do it and you want to do it, as I mentioned, that would be something that would not be clawed back. You would use you lock in your exemption now. Making gifts doesn't mean that you shouldn't make smaller gifts, because you still should look at everything. But I do believe, although nothing's clear, that if you make a gift of $2 million and the exemptions go to 5, you don't still have another 5, that you would have 3. But
Okay.
stay tuned.
Yeah, great. Thanks, Howard. And that concludes our presentation today. I'd like to thank all the speakers. Everyone did a great job, as well as like to thank Elisa and Stephen and their team for making all this possible. And to everyone out there, thank you for joining us. I hope everyone stays safe and carries on. Thank you, and have a good day.